Something is happening in Rolex, and this could change everything. For the first time in years, Rolex buyers have leverage again. Not everywhere, not on every model, but on some watches. Now, dealers that are not supposed to need you will beg for your attention because they want to dump these 7 models on you. These models have been sitting on dealer shelves with prices coming down. And every single one of them is falling for a completely different reasons. In this video, I'll tell you about those watches, beginning with the watch that retail pricing accidentally broke. Number 7. Rolex Submariner 124060. A 2024 Submariner no date in full set condition was trading at around $13,800 in December 2025. New retail after the January 2026 price increase came in at $13,050. The gray market premium is now less than 8%. That number matters because 8% is not enough. It is not enough to justify buying unseen from a gray dealer when the authorized dealer down the road has a list that is actually moving. It is not enough to compensate for the condition risk, the service history questions, or the lack of the 2-year international warranty that comes with a new purchase. The premium used to compensate for all of those things because it used to be 50%. At 8%, the gray market Submariner is not a deal. It is a gamble with a thin upside. What happened is that retail crept upward while secondary prices held flat. Rolex raised prices in January 2025, again in May 2025 to absorb the initial tariff, and again in January 2026. Each increase narrowed the gap between what a gray dealer needs to charge and what a patient buyer can get by simply waiting at retail. The gap closed to the point where rational buyers walked away from the gray market entirely. This is what analysts are calling the ceiling effect, and the Submariner is the clearest example of it in the current market. When a retail price increase lands on a watch whose secondary market has already compressed, the increase does not lift the secondary floor. It lowers the ceiling. The new retail at $13,050 is so close to used examples at $13,400 that buyers are actively choosing the wait over the premium. And the gray market dealer holding that used Submariner cannot afford to close the gap further because closing it means selling below their own cost. Dealers who bought Submariner inventory at 2024 secondary prices and are now trying to sell in 2026 are caught in the most uncomfortable position in this market. Sitting on an asset that is too common to be scarce, too well known to be undervalued, and too close to retail to command a premium. The only move is down. The dealers who need liquidity are making it. The dealers who do not need it yet are watching their margin evaporate by the quarter and hoping the market moves before they have to join them. This is not a story about the Submariner losing its desirability. The watch is as wanted as it has ever been. It is a story about arithmetic running out of room. There is a second problem layered underneath the ceiling effect, and it is specifically about the gray dealer's cost structure. Gray market dealers do not operate on thin margins by choice. They operate on the margins the market gives them, and for years, the Submariner market gave them enough margin to absorb the costs of running an authentication service, maintaining inventory, and offering buyer guarantees that the standard private seller does not. When the premium was 50%, a 10 to 15% operating cost was sustainable. When the premium is 8%, the same operating cost structure makes the trade unprofitable unless the dealer raises volume dramatically, which, in a softening market with more sellers than buyers, is not available to most operators. What this means practically is that gray dealers who cannot turn the Submariner profitably are either exiting the reference entirely or pricing to move at whatever margin they can recover. Both outcomes add supply pressure to a market that does not need more supply. The Rolex Certified Pre-Owned Program, which Rolex launched through authorized dealers in 2023 and which generated over $530 million in sales in 2025 alone, adds a further competitive layer. A Rolex-backed used Submariner with a warranty from an AD is a stronger proposition than a gray market example at a similar price. The gray dealer is now competing against the brand itself for the same buyer. That is not a competition they were designed to win. From the watches that retail broke to the watches that speculation built, and what happens when the speculators need the exit at the same time. Number 6. Rolex GMT Master 2 Pepsi and Batman. The Pepsi 126710BLRO and the Batman 126710BLNR were the two references with the heaviest speculative overhang coming out of 2022. Every flipper who wanted one bought one. Multiple flippers bought multiple. The waiting lists were cultivated aggressively, with gray market buyers camping outside boutiques, building parallel AD relationships across multiple cities, and coordinating allocation intel through private group chats. At its peak, the Pepsi was trading at $25,000 against a retail price of $11,100. The Batman was not far behind. The correction came, and both fell hard. Steel sports models dropped 30 to 50% from their 2022 peaks across the board, and the GMT variants took the full weight of that fall. The Pepsi dropped from $25,000 to somewhere between $14,000 and $16,000, depending on condition and channel. Still above retail, but the person who paid $25,000 for one is not celebrating that number. Here is what is driving the current pressure. The people who held through the correction, the flippers who told themselves they would wait for the recovery, are now 4 years into a waiting game, and the recovery has not arrived in the form they expected. 4 years is a long time to hold an illiquid asset in a market that requires active monitoring. Every quarter that passes without meaningful price recovery is another quarter of opportunity cost, of storage, of insurance, of carrying costs that do not appear in the listing price, but absolutely appear in the seller's calculation. When those holders finally decide to sell, they do not sell one at a time over a spread of weeks. They sell when confidence breaks. And confidence tends to break in clusters. One large holder liquidates. Others watch the price compression happen in real time. And the urgency to exit before the next compression accelerates. The person who exits at $14,800 is better positioned than the person who waits for the next holder to exit at $14,200. That logic plays out simultaneously across multiple holders of the same reference. The Pepsi and Batman are not being dumped because dealers stopped wanting them. They are being dumped because the people who bought them as assets have run out of patience, and patience was the only thing holding the price up above the level that genuine watch buyers, the people who want to wear them, not flip them, are willing to pay. The floor for the genuine watch buyer on the GMT Master 2 is the price at which the watch makes sense as an object rather than an investment. That number is somewhere between $14,000 and $16,000 for the most desirable references in 2026. Still a premium over retail, still a real premium, but a premium built on desire rather than speculation. The dealers who bought at speculative prices and are now selling at genuine buyer prices are absorbing the difference between what a watch is worth to someone who wants to own it and what it was worth to someone who wanted to flip it. That gap, measured in thousands of dollars per watch across hundreds of units held by dozens of dealers, is what the dumping headline is actually describing. Before we get to the 3 models at the top of the list, let me know which one of these watches has gotten your interest right now. From the speculative exit to the watch, that the economic environment broke, and why the most iconic reference on this list has the most complicated story. Number 5. Rolex Daytona 126500LN. The Daytona is still the most desirable watch Rolex makes for most people who know what Rolex makes. That has not changed. The watch fell from highs above $50,000 used in 2022 to the mid-30s in 2025 and 2026, and the mid-30s is still a premium above the roughly $18,000 retail price. By the standard of every other watch on this list, the Daytona is holding up better than almost anything else in the steel sport catalog. The problem is not the watch, it is the buyer. The buyer who could stretch to $30,000 or $35,000 for a used Daytona in 2021 was making that decision in a specific economic environment. Interest rates were at zero. Equity markets had recovered sharply from the pandemic dip and were hitting new highs. Pandemic savings were sitting unspent in accounts earning nothing. And there was a collective cultural moment around luxury goods as alternative assets, the watch forum calculus that a Daytona was a better store of value than cash, and the financial media coverage that reinforced it. That buyer is a different person in 2026. The mortgage on the house they bought in 2021 has either reset at a significantly higher rate or is about to. The equity portfolio has had a difficult stretch. The disposable income that was available for a $30,000 discretionary purchase has been absorbed by costs that simply did not exist at the same level 3 years ago. Higher borrowing costs, higher insurance, higher food and energy, higher everything. The buyer has not stopped wanting a Daytona. They have stopped being able to prioritize it at the current price relative to everything else competing for the same money. Dealers who are holding Daytona inventory priced for 2021 economic conditions are now in a market of 2026 buyers. They can hold and wait for conditions to improve, which requires capital and patience that not every dealer has in equal supply. Or they can price for where the buyers actually are right now. The ones doing the latter are what the title of this video is about. The Daytona will recover when economic conditions for the target buyer recover. That is not a question of if. It is a question of when. And until it happens, the dealers who cannot wait are creating the buying opportunity. The dealers who can wait are hoping someone else takes first. This creates the specific dynamic the title of this video is pointing at. The Daytona market in 2026 is not a market of universal price decline. It is a market of dealer-specific distress. The dealer with strong cash flow and no urgent liquidity needs is holding firm at $33,000 to $35,000, waiting for the economic environment to shift back in their favor. The dealer with carrying costs mounting and inventory financed at current interest rates does not have that option. They are pricing to move. The gap between those two dealer types is what produces the listings at $30,000 that the holding dealer cannot match without taking a loss they are not ready to take. When you see a Daytona priced below the market, you are almost certainly looking at the second type of dealer, not a mispriced watch. The watch is correctly priced. The dealer's cost structure is what created the number. From the watch whose buyer changed, to the watch whose buyer is being too smart to move, and how patience becomes a problem. Number 4. Rolex Explorer 124270. The Explorer was the watch serious collectors bought when they wanted to avoid the flipper circus. No Q gaming, no AD relationship cultivation for allocation, no gray market premium that doubled the price and removed the warranty. Just a clean 36mm case, a dial that the community agreed was one of the most legible Rolex ever produced, a movement running within 2 to 4 seconds per day in real-world conditions, and a price that felt honest relative to what you were actually receiving. The Explorer attracted a specific buyer profile: informed, patient, research-driven, not motivated by social signaling. This is the person who has read every major forum thread on the watch before committing. The person who knows the lug-to-lug measurement, the service history of the 3,230 caliber, the secondary market depth across the last 3 years. The person who, when they decide to buy, buys decisively and does not second guess. And when they decide not to buy yet, does not move until the decision is clear. That buyer profile is now the problem for dealers holding Explorer inventory. When the informed, patient, research-driven buyer looks at the current Explorer market, they see a premium that has compressed from meaningful to marginal, a waitlist that is genuinely shorter than it was 2 years ago, and a gray market price approaching retail closely enough to raise the question of whether the premium is worth it at all. The rational response to that set of conditions is to wait. If prices are falling and availability is improving, the cost of patience is low. The cost of being wrong, of buying at $14,000 when the market finds $12,000, is real. This is not irrational behavior. It is exactly the kind of thinking the Explorer community has always valued. The problem is that a market full of rational, patient buyers and no speculative buyers underneath them produces very thin liquidity. Nobody is buying on impulse. Nobody is buying for the fear of missing out. Nobody is buying because they saw it on Instagram. The only buyers are people who have done their research, reached a considered view, and concluded that now is the moment. And the research keeps suggesting that now is not quite the moment yet. Dealers who bought Explorer inventory, expecting it to move with the same energy as the Submariner or GMT, are sitting on a watch that the most desirable buyer profile in the market has rationally decided to defer. The watch is fine. The market for it is temporarily in the hands of people who are too well informed to be urgently moved. The specific problem this creates for dealers is that you cannot manufacture urgency for a buyer who has removed urgency from their decision framework. You cannot create fear of missing out for someone who has looked at the supply data and concluded there is currently nothing to miss out on. The Explorer Dealer's Playbook, which in 2021 involved waiting lists and allocation conversations, has been replaced by a negotiation playbook where the buyer has more information and more patience than the seller. That is a fundamentally different transaction, and dealers who have not adjusted to it are sitting on inventory priced for a market that no longer exists. From the rational buyer's trap to the model that drowned in its own popularity, and the inventory problem, no other watch has quite like this one. Number 3. Rolex Datejust 126300. The Datejust is the most traded Rolex reference in the entire gray market. Not the most desirable by collector consensus, not the most culturally significant, the most traded, the highest transaction volume, the most chrono 2-4 listings, the most hands it changes in a given month across every secondary channel globally. During the 2020 and 2022 boom, dealers stocked it aggressively, precisely because it moved volume. The Datejust was the reliable machine in every dealer's inventory. It had reasonable margins per unit, consistent buyer traffic from people who wanted Rolex but could not access the sport references, and a price point low enough to attract buyers who were spending luxury money for the first time. Dealers bought 30 units when 10 would have been rational, because at the time, buying 30 was the right decision. The market was absorbing everything. The boom ended. The 30 became the inventory problem. What makes the Datejust situation categorically different from every other reference on this list is the competition structure. When a dealer needs to liquidate a Submariner, they are competing against every other dealer trying to move a Submariner across a total pool that is constrained by production limits and genuine collector demand. There is a floor below which the Submariner will not fall because genuine demand supports it. The Datejust has no comparable floor. The total pool of Datejusts on the secondary market is effectively unlimited. Every dealer who overstocked during the boom is now competing against every other dealer who overstocked, across a reference where condition, completeness, and specific variants create enormous price variation that makes comparison shopping easy for buyers and race to the bottom pressure inevitable for sellers. The Datejust buyer has options. They have 20 pages of chrono 2-4 listings and the patience to filter them. The Datejust seller does not have options. They have carrying costs, storage, insurance, and the knowledge that every week they hold, another distressed seller somewhere is pricing below them to clear their own inventory. The Datejust will remain under significant pressure until the market-wide overstock clears, which requires not one dealer liquidating, but every dealer who overbought doing the same, simultaneously, at prices low enough to actually generate buying velocity in a market where buyers are not in a hurry. The irony is that the Datejust has always been the most accessible Rolex, the entry point, the watch that brought more people into the brand than any other reference. In the current market, it is also the most trapped inventory, too common to be scarce, too expensive to be impulse purchased, and priced in a gray market with more supply than demand for the first time in a decade. From the volume problem to the watch that was always priced by real buyers, and what happens when real buyer pricing is the only pricing left. Number 2. Rolex Yachtmaster 4 0 Ref 126622. Every reference that held premium in the 2021-2022 bubble held it for one of two reasons: genuine scarcity enforced by Rolex controlling production and allocation, or speculative demand piling on top of that scarcity and amplifying it. The Submariner had both. The Daytona had both. The GMT had both in quantities that made their premiums feel like gravity rather than air. The Yachtmaster had neither in any meaningful form. Nobody built a Q gaming strategy around the Yachtmaster. No Flipper network coordinated allocation intel for the Yachtmaster across multiple AD relationships in 3 cities. The watch existed in a quiet section of the Rolex catalog, bought primarily by people who genuinely wanted to wear it, typically buyers drawn to its sportier styling compared to the Datejust and its slightly lower key profile compared to the Submariner. These are real buyers making taste-based decisions. They are not buyers making thesis-based investment decisions. In a functional market, that buyer profile is exactly what you want. Real demand from real owners is the most stable foundation a secondary market can have. But in a bubble market where gray market premiums are set by speculative accumulation and every Rolex reference gets bid upward because the brand itself is the asset, the absence of speculative buyers is indistinguishable from weakness. The Yachtmaster was already trading at or below retail during periods when the Submariner commanded 50 to 60% premiums. Dealers who bought Yachtmaster inventory during the boom, expecting it to participate in the general Rolex elevation, found that it was always priced by genuine demand. And genuine demand at $12,000 for a watch most sport Rolex buyers would rather spend on a Submariner or GMT is thinner than the boom made it look. Now that speculative support has been removed from the entire market, the Yachtmaster has not fallen further in relative terms. It was never elevated to begin with. What has happened is that the dealers who paid elevated prices for it during the boom, expecting Rolex brand support to provide a floor, discovered that the floor was always lower than they paid. The correction is not the Yachtmaster falling. It is the Yachtmaster returning to where it always should have been, from the level dealers mistakenly paid for it. The Yachtmaster tells you something specific about how the boom distorted dealer reasoning across the entire Rolex catalog. During 2020 and 2022, premiums on the Submariner and GMT were so consistent and so widely reported that dealers began treating the premium as a property of the Rolex brand rather than a property of specific models in specific market conditions. Every Rolex held value. The more desirable models held more. Therefore, all models held at least some meaningful premium. Dealers who applied that logic to their Yachtmaster buying were not being irrational. They were extrapolating from a real pattern in conditions where the pattern happened to be real. The pattern was model-specific, not brand universal. The Yachtmaster's genuine demand floor was always lower than the boom's general elevation made it appear. What reads as a Yachtmaster collapse in 2026 is actually correct pricing becoming visible now that the distortion has been removed. The dealers holding them are paying the cost of a diagnosis that came 3 years late. The watch did not change. The market's willingness to overpay for it did. From the watch that hype forgot to the watch that lost the argument to its own sibling, and what happens when two watches occupy the same price territory. Before we move on to the next part, let me tell you this. Most people don't realize this, but buying a watch the wrong way can cost you thousands, and you won't even notice it until it's too late. You walk into a store or browse online, and everything looks the same, but behind the scenes, there's a system. Prices aren't always fair, availability is controlled, and one bad decision can leave you overpaying for something that doesn't even hold its value. That's why I created a complete free insider guide to buying watches. Inside, you'll find the best watches to buy, the watches to avoid, and how to choose a watch that actually fits your style and budget long term. The goal is simple. I'll help you stop guessing and start buying smart. You'll find the free guide in the pinned comment and description. Now, let's move on to the next part. Number 1. Rolex Air King 126900. The Air King returned in 2022 with a case built around the same oyster architecture as the Explorer. A black dial carrying the Rolex crown logo prominently at 12 o'clock, alongside the word Rolex in green and Air King in white, a price point sitting squarely in Explorer territory, and a design that divided the watch community sharply the moment it appeared. Rolex had real reasons to bring the Air King back. The nameplate goes back to the 40s when Rolex produced watches for Royal Air Force pilots. Genuine heritage, not manufactured nostalgia. An oyster case with a screw-down crown and 100-meter water resistance at the same specification level as the Explorer. A distinctive dial that does not look like anything else in the Rolex catalog. An entry price that sits below the Submariner and GMT, making it the most accessible point of entry into a steel Rolex sport watch with serious credentials. The problem is not the watch itself. The Explorer 124270 is 36 millimeters, the same as the Air King. It runs the same caliber 3,230. It is priced within a few $100s of the Air King at retail. Its dial is regarded by a very large portion of the watch community as one of the cleanest, most honest Rolex dials in production. It has a secondary market with genuine depth, years of transaction history, and an established price floor that the Air King's 2022 relaunch has not had enough time to build. When two watches share an architecture, share a price territory, share a movement, and differ primarily in dial design, the newer one faces a headwind that is very difficult to overcome purely on design merit. Dealers who bought Air King inventory expecting it to trade like any other steel Rolex Sport reference found that it traded like the least demanded steel Rolex Sport reference. It sat when the others moved. It moved slowly when the others cleared. And in a correction, the reference at the bottom of the demand hierarchy takes the most damage because there is nothing beneath it to provide a floor. When a buyer is choosing between an Air King and an Explorer at similar prices, the Explorer wins the conversation almost every time. The Air King dealers are left pricing down to find the buyers the Explorer conversation did not reach. There is a version of the Air King that finds its audience over the next 5 years, as the design earns more community acceptance and the secondary market builds depth. That version exists in the future. The version that exists right now is a watch that needs buyers to choose it over the Explorer on pure taste, in a market where taste-based decisions are being made more carefully than at any point in the last decade. None of these 7 watches are broken. The Submariner is still the benchmark dive watch. The GMT is still the benchmark travel reference. The Daytona is still the watch most people in this space would take if offered it freely. The Explorer is still the most honest Rolex money can buy at its price. The Datejust is still the most versatile watch in the entire catalog. The Yachtmaster and the Air King are still genuine Rolex watches with genuine Rolex engineering inside them. What broke is not the objects. What broke is the assumption that underpinned a decade of dealer inventory decisions and a decade of gray market buyer behavior, that buying any Rolex, at any price, at any time, was a guaranteed path to preserved or enhanced value. That assumption was never universally true. It was true for specific models in specific conditions. The Submariner, when supply was tightly rationed and waitlists were the only path to ownership. The Daytona, when speculative buyers competed for allocations and the gray market sat at 3 times retail. The GMT, when new two-tone ceramic variants drove annual hype cycles. But it was never true for the Yachtmaster, which was always priced by genuine demand with no speculative floor beneath it. It was never reliably true for the Air King, which was always competing for the same buyer as the Explorer and losing the comparison. It was not even dependably true for the Datejust, which was always the most common reference in the gray market and therefore the most exposed to supply pressure when dealer sentiment shifted. The dealers sitting on falling inventory built their purchasing decisions on a version of that assumption that the market validated for long enough to act on, and then stopped validating, model by model, reference by reference, in the order that each model's specific support structure collapsed first. The inventory on those shelves is not evidence of bad watches. It is evidence of which models the belief left first. If you have been watching this market and waiting for a signal, that sequencing is the most useful data available. Whether you read it as an opportunity or a warning depends entirely on which side of the transaction you are standing on, and which of the 7 you are watching most closely. The watches did not change. The market's willingness to pay what the boom demanded for them did. Those are 2 different problems. Only one of them is fixable by pricing down. The one that is not fixable by pricing down is the one the dealers on this list are still waiting for the market to solve. If this kind of analysis is useful to you, like this video and subscribe.